This meeting is now being live streamed. That means it's value after hours. I'm Tobias Carlisle, joined as always by my co-host Jake Taylor. A special guest today is Conor Maguire, value situations. He's a special situations investor based in Dublin, Ireland. He does special situations from all around the world. I've been reading his Substack for a little while. It's very interesting. So we're going to get into what Conor's about. How are you, Conor? Nice to meet you.
I'm
Welcome.
good, thanks, Tobias. Good, Jake. Nice to speak with you both, and thanks for having me on. I think, as I was saying just before we went live, there, I'm a long time listener, but first time caller. So it's good to be on the podcast with you.
We're going to get every single listener on the podcast eventually,
All 10
given
of
enough
them.
time.
Yeah. I'm surprised we haven't already cycled through them, to be honest.
Connor, tell us a little bit about value situations.
Yeah, so Value Situations is the name of the Substack or the newsletter that I write. I've been doing it now for about just over 3 years. So my background is originally I qualified as an accountant. Then I worked in kind of corporate finance, investment banking roles, and then I worked for one of the large, well-known international PE firms here in Ireland. And then I kind of just decided to go out and do my own thing a couple of years ago and set up my own newsletter. I thought that was kind of the quickest route to market, so to speak, in terms of getting my ideas out there. And that's been a really interesting experience. Kind of that's kind of one of my main, that's the day job, so to speak. And then I also do some consulting work with family offices on equities as well, kind of some of which overlap with the types of ideas I write about in the newsletter. And then others are more kind of bespoke kind of situations.
Give us an idea of the strategy. What are you looking for in broad terms?
But I suppose I have a kind of a framework that I kind of a three parts or three elements to it. So one is where it's where there's an asymmetric risk return profile. Bless you.
Did I mute it in time?
Yeah, you
I
got
think
it.
I didn't hear it, but got the visual. Um, so it's basically, so my three kind of elements to it really, I suppose, are kind of valuation, obviously the clues in the title. So valuation focused, where I don't kind of really concern myself with kind of P ratios and EPS numbers. I kind of take a more, I suppose, valuing the business on an entire enterprise basis and looking at the whole value of the whole company and its assets and so on. So kind of really kind of a more comprehensive view on valuation rather than kind of headline P ratios. Then kind of, I suppose, given with my background in private equity, and I worked in kind of credit and distressed and special situations, was kind of on downside protection. And that's really, I suppose, looking at the balance sheet, again, looking at the asset base, what kind of asset coverage is there, what kind of cash generation, or what other kind of protections are there in a kind of you know a liquidation scenario, or in the event that kind of you're wrong in your initial assessment, kind of what's the backstop there in terms of value. And then really, I suppose, kind of combining those two elements, valuation, where I'm kind of looking for a certain level of upside, and then matching that against kind of what I think the downside is, and what's the worst case in the downside scenario, and kind of that I want to see a very kind of asymmetric kind of risk reward or risk return profile, where typically the upside is three times the downside risk, is kind of how I just kind of, that's kind of the minimum kind of hurdle I'd kind of try and look for. So that's kind of, I suppose, at a high level, that's kind of the framework I kind of try and employ all the time.
Did you
Do you
get
want to take
the memo that we've gotten rid of bankruptcy in the US?
Yeah, I mean that's an interesting one, I suppose. I think I just remember back in 2019 before COVID hit, and all the that the kind of flood of stimulus came along, but the kind of, there was a lot of concern at the time about leverage loans, and kind of just how that was just 90% of issuance in 2019, I think, was covenant light. And you're kind of thinking that this isn't going to end well. And then obviously COVID came along. There's the pretend and extend kind of has become a fairly well understood kind of factor, I suppose. And yeah, we're not seeing that in default rates since, but yeah, so yeah, but bankruptcy, I mean, it's not the I suppose it's not the kind of the obvious outcome that maybe it used to be, just the way markets have kind of evolved. So that's, yeah, it's certainly an interesting um area to kind of, I suppose, be mindful of.
Yeah, I
Can
mean,
you
I was being glib, obviously, but it is. I've personally felt a little bit like Chicken Little sometimes. Like I was worried about Cov Light. I was worried about like, God, there's the spreads are super low and tight right now. Like no one's really seems that concerned. No one's asking to get paid to take risk, and a lot of these, uh, CLO type of, pretty
Yeah.
complex transactions that lots of ways that things could go wrong, and it kind of seems like it just hasn't really mattered. So I don't know. It's like, is it just not yet, or was I just being too pessimistic?
I think a big factor, and I suppose it's an area I used to kind of partly work in terms of the whole private credit universe, is that the ability and the appetite to kind of restructure or amend loan terms when things get a little difficult or stretched is much greater, I suppose, than maybe banks and previous kind of traditional leverage loan investors. Now that's with rates coming down, leverage loans are getting a more of a, I suppose they're winning back market share from kind of private credit, which has just exploded. So I mean, private credit's now bigger than leverage loan market and the high yield bond market. So you've got kind of three very high risk appetite parts of the loan market now, as opposed to it used to just be really two in terms of real scale. So I think that's a big factor. And you look at kind of what firms like Apollo and others are doing in terms of the machine they've built up around private credit. I think banks have retrenched, as we all know, and I think the structure of the market is different now. So I think that has to be some a factor, some in terms of where default rates are relative to what maybe we would have previously expected.
Could you foresee a day where we're all collectively bailing out this shadow banking world?
It's hard to know. I mean, you think when you look at previous kind of collapses and loss of confidence, it's the panic selling and it's the withdrawal of liquidity. And I mean, the last market episode or event where we kind of maybe got near that was the UK pensions crisis and the UK government gilts. So it wasn't even the really racy types of credit that were causing issues back then, although everything else was affected. But you saw what happened. Then the Bank of England stepped in almost immediately.
Yeah, whatever it
And
takes.
whatever it takes. And we're seeing that now. China's now kind of maybe has that kind of whatever it takes mindset as well. So it's kind of hard to know. And there's so much liquidity still in the system, really. And I think also you've got, when you look at what I call the private capital complex, and I don't know what dry powder is at globally now. Maybe it's well over three trillion. But then the flip side of that is that there's a similar amount maybe of portfolio companies that haven't been exited or monetized yet. So so it's hard to know. The markets in that respect, private capital is more opaque than previously bank-led financings that kind of dominated markets maybe pre-COVID. So or in the pre-COVID era maybe. So yeah, I suppose that's something we just need to be mindful of.
This conversation usually happens after the veggies. We got dark early. Where
Sorry.
let's Connor, give us an example of one of your ideas. I think you suggested DWL. Do you want to take us through that one?
Yeah, sure. So yeah, a lot of the ideas I look at are typically not by design, but just by, I suppose, I trying to go where the value is typically more so in European markets, European equities at the moment, and particularly, I suppose, in the last 12, 18 months, the UK. So, the UK, it's been well reported, it's out of favor. No one wants to own UK equities. Even the UK pension funds don't want to own UK equities. So, in the absence of buyers, I just kind of tend to find that there's a lot of stocks and situations there that seem to be mispriced. And a lot of these things are cyclical as well, and things will rebound and flows will return. And I think, you'll either these situations will eventually play out in a positive way. So DWL, which is Dowlais Group, which is a UK listed auto parts business. So it basically makes the side shafts and prop shafts in cars. So the kind of the components that connect the wheels to the base of the car, and it so it's a UK listed business. At the moment it's about a 700 million market cap business, and it was spun off from another UK listed company called Melrose Industries, which is a kind of pretty much another UK listed business that was kind of a listed private equity kind of turnaround shop. So Melrose originally acquired a company called GKN, which was two segments, auto parts and aerospace. So Melrose spun out the auto parts business, and called it Dowlais Group PLC. So it's now an independent auto parts business. It's the market leader in its segments in terms of the components it provides, and the interesting thing about this business itself is that it itself has two segments, and management recently stated that they were going to spin off, they're looking at a strategic review where they're likely to spin off, I think, what's, I suppose you could deem a non-core segment now, which is called the powder metallurgy. So they make kind of metal powders, which are used to make all kinds of metal components that typically in the automotive industry, but also there's a whole range of industrial end markets that use these kind of components like bearings and so on, and magnets as well as one area where they're getting into. So it's a really niche industrial business. But if you look at kind of what the likely private market value of that segment is, if they spin it out, it's worth, I think, over 100% of the entire market cap of the Dowlais business listed today in London. And so if you back out the implied private market value based on transaction comps and other listed comps, the core auto business, which is £1 billion sterling business, and it's the market leader, as I said, in its components. I think it's 1 in 2 cars globally is estimated to have one of these Dowlais auto parts in the vehicle. So it's a pretty well established, solid business in its niche. It just happens to be in a really out of favor industry at the moment in auto parts, where everything is just no one is really too keen on that at the moment. But if they spin out if they spin out this powder metallurgy segment at anywhere near the value I think it might be worth, the implied multiple on the core business is sub 2 times EBITDA. And you look at listed peers in Europe and the US now, and they're kind of 4 to 5 times. So I think there's a lot of value there. Going back to kind of my framework in terms of valuation, when you break apart the segments and you look at what are these really worth, I think, and then you look at the downside protection in terms of the asset coverage there. I think it's a really interesting breakup situation where I think, you're well covered on the downside in terms of if they spin off this powder met business at a reasonable multiple, it totally de-risks the balance sheet, its net cash position. You've got a leading auto parts business that, it's not like it's producing fancy auto components. These are fundamental to any vehicle, and they're well established. They've got all 90% of the leading auto OEMs globally, they've got long established relationships with. So they're kind of a key supplier there. Also, I suppose the interesting thing about this business as well is that if you look at the one part of the auto industry that's actually doing well, or in relative terms, it's been Chinese electric vehicles, which have, really gained market share. Again, Dowlais are a supplier to the top 10 electric vehicle manufacturers in China. They have a JV in China. So they're actually benefiting from, if Chinese EV manufacturers come into Europe and steal market share from incumbents here, Dowlais are going to benefit from that. And they're kind of got a reasonably agnostic kind of portfolio in terms of the ICE, internal combustion engine vehicles, and then electric vehicles as well. So it's kind of well positioned from an auto market perspective. If you believe the auto market's going to recover from the current, challenge that it's undergoing. And then in any event, even if the auto market kind of doesn't really uptick meaningfully in the next 12, 18 months, you've got an event catalyst here with the spin-off of the powder met segment, which I think could, you could see management, initiating some kind of buyback or special distribution, which can catalyze value as well for shareholders in the meantime. So I think that's a really interesting situation. Again, I think no one really is too aware of it. It's doesn't have a huge amount of analyst coverage. So I think that's a good example, I suppose, of where I'm kind of finding value at the moment. And it's the type of stock that I think, as David Einhorn and a few other people have said, no one cares about these companies. So the other aspect to it is, it's probably likely to be a takeover target itself if they spin off powder met, deleverage the balance sheet, and the market still doesn't care. Somebody's going to take a run at this, I think. And you look again to talk about private credit and the kind of the dry powder that's out there with in the private capital world. I think there's it's a very plausible takeover target. I mean, the other interesting aspect to this again is going back to the original takeover of GKN, the predecessor business, was that that was a hostile takeover process, and there was a number of US auto parts businesses that were interested. One of them actually bid on the auto business that became Dowlais, at the time Dana Incorporated. So there's precedent there where you could see some kind of consolidation in the market, and given everything that's going on with the auto industry, and Dowlais is, again, it's an obvious takeover target, I think, if it doesn't re-rate in time.
Have they
Probably
announced the spin?
look pretty good from a acquirer's multiple perspective.
2 times, yeah. Have they announced that spin, or is that you saying that
Sorry,
they might?
they've announced a strategic review. So
Okay.
at the where they're going to exploring this, and I think, just to put that in context as well, at the initial capital markets day, when the company went public, or when it was spun off from the previous parent, that was one of the things the management flagged at the outset. They said within, I think it was 18 or 24 months, they would consider the ownership position on the powder metallurgy segment. So, true to their words, they've done that within that kind of time frame. So, yeah, so I think that's a really interesting one. Again, nobody's really looking at it. It's you could argue that it's the type of company in the current market environment that's probably too small to remain public, potentially. People just don't care about these small caps, particularly if they're, kind of industrial, kind of, perceived old tech type businesses.
I've got a few questions from the crowd here. One is, why is it historically loss-making?
I mean, since it's gone public, I mean, it's kind of positive free cash flow. It has been positive free cash flow, and it has been positive on an EBITDA and EBIT basis. So I'm not sure what the loss-making observation is there, but certainly, cash flow in the last 12 months has taken a bit of a hit because they've incurred some exceptional charges in terms of post-spin. There's been kind of some restructuring. They're closing 2 plants, and they're reopening new plants in cheaper locations and so on. But unless your commenter there is looking at maybe kind of the financials that were when they were part of the previous Melrose structure, where there might have been other kind of central costs or something. But no, it's been, since it's gone public, it's been earnings positive.
I've got one here. Which part of the DWL business contributed to the recent profit warning?
Yeah, that was the auto business. So that's everything that's going wrong with autos, and the large Western manufacturers scaling back EV production. So that's obviously impacted them. But on the flip side, Dowlais are kind of benefited from the Chinese incursion into the European EV market. So yeah, it was the auto business that kind of. But again, that's the same factor with the same issue with every auto business at the moment.
I had a few. Let me just give a shout out to folks at home. Hopefully I can do this in a reasonable time. I'm gonna miss the first one.
Riveting right here.
So,
this is
good TV. Good TV.
Yeah, this is great.
Petah Tikva, Israel, Bellevue, Toronto, Santo Domingo, Philly, Andhra Pradesh, India, Bendigo. Good for you. Early start, late night, Toronto. Dubai, London, Savonlinna, Finland, Lebanon, Helsinki. What's up? Valparaiso, Mac, how is it? Lausanne, Switzerland, Snohomish, France, Walnut Creek, Palestine, Jupiter, Florida, Moncton, New Brunswick, Manchester, England. Pants Party saying this is amateur hour, not value after hours. It's actually probably a better name for it. Cromwell, New Zealand, Spastic, Lithuania. I might be cancelled after that one if that's not a real place. Hamburg, Germany, Paso Robles, Kuressaare, Estonia, Scotland, Tallahassee, Hamburg, Tomball, Texas, Omaha, Phoenix. Thanks,
God,
fellas. We
can't-
appreciate it. Chemnitz, Germany, Mendocino. Awesome. Thailand. Good one. That was good stuff. I've got a comment here. Many experienced UK private punters have been burned on Dowlais. Many given up and sold after big losses. Seems interesting. Sentiment worse than rock bottom. That's from Value Hurts. So he's
So
a real
he's
value investor.
yeah.
Yeah. Yeah, that pretty much sums up the sentiment, all right, yeah.
What was the like at its peak? How big was the market cap of this company?
Oh, well, I mean, when it spun off,
Yeah.
it was, I think, about would have been about 1.4 billion, maybe pound sterling.
Okay.
Did we say that
Or,
Connor's coming to us from Dublin, Ireland? I don't know if I should have given Dublin, Ireland a shout out on the
Yeah.
list.
We led with that. That's okay.
Do you want to take us through one more and then we'll do JT's veggies? OCI. We've gone
yeah,
from London to it's Dutch.
yeah. So OCI is it's Dutch listed. It's a complex one. In it another one of these kind of multiple segments where it's a breakup story essentially again. And so it was a fertilizer business listed in Holland, but over 50% of the business was actually an Abu Dhabi listed venture that they owned with Middle Eastern investors. So complex structure with yeah, it's interesting. It was the was the third largest ammonia fertilizer producer in the world behind CF Industries and I think Nutrien in the US and I think Nutrien's Canada listed. But so one of the major nitrogen fertilizer businesses, but not really well known. It's 40% roughly controlled by an Egyptian billionaire called Nassef Sawiris, if I'm pronouncing that right. So he has an interesting track record of kind of creating value. He built this business up it was initially a kind of an offshoot of a family-owned construction business. Built it, I think he originally tried to sell it. It had at the time European and US nitrogen fertilizer business, tried to sell it to CF Industries back, I think in 2015. That didn't work. I think at the time, I think it was due to maybe antitrust concerns. So then he decided to build a competitor to CF, which he pretty much did.
Is that
But
CF Industries, the US listed CF
correct, yeah.
Industries? Yeah, okay.
Yeah, yeah. So had tried to sell it to CF, that didn't happen. So built basically a competitor to CF, but in a pretty clever way, where he partnered with Middle Eastern investors, acquired just over 50% interest in an Abu Dhabi listed fertilizer producer called Fertiglobe. So, and the clever aspect of that was when the energy crisis hit and natural gas prices went crazy in Europe, and CF and Yara and a lot of other producers had to shut down capacity. Um, OCI had the benefit of very cheap natural gas supply from Middle East, which meant they were able to very, very profitably produce gas and ship ship ammonia and other fertilizer products to Europe with a cost advantage that even some of the US producers didn't have. And so, but long story short, it kind of didn't really get recognized in terms of the value or the kind of the sum of the parts. And Jeff Ubben, who's the activist investor, he got involved, recommended the board do a strategic review, which they undertook. And since then, I mean, I think that's about 15 months ago, maybe. Since then, they've basically broken up the business. So they had four elements to it. They had a methanol business in the US, they had a US fertilizer business, They had Fertiglobe, which is the Abu Dhabi listed fertilizer business, and then they had a European nitrogen fertilizer business. So all that remains now is the European assets. So they've done deals to sell the US fertilizer business to the Koch Industries. They've sold the Fertiglobe business to, I think it's ADNOC, the Qatari national energy company. And they've sold the methanol business to I think it's Methanex, the US listed methanol business. So, I mean, they had a market cap of, at the time, in, if you remember, I think Euro terms, something like 6 billion, and they've realized about 11.6 billion in proceeds since then.
That's good work.
So a lot of so I mean, a lot of I suppose the interesting thing there was that management acted when the market didn't value the business properly. They engaged with an activist, and they've realized they've unlocked a lot of value for shareholders. And I think at the moment, I think the share price is something like 25, 26 euros a share. They're going to pay out a special dividend of about 14 euro 50 between now and year end, is kind of the timeline they've indicated. So you're getting 50%, 60% of the share price back in cash before year end, and you're left with a European fertilizer business that at the moment is probably break even or marginally profitable, just given cost base and some of the energy prices are still elevated and demand has been subdued for fertilizer since the energy crisis. But it also owns a really interesting infrastructure asset, so that it owns the only ammonia import terminal in the port of Rotterdam in the Netherlands. So that's a pretty unique infrastructure asset. I don't even think that's actually really been reflected in the earnings, or the stabilized earnings of the business. So you've got it's at 27 or 25, 26 today. You're gonna get 14.50 back. And I think there's total value somewhere between 35 and 40 euro if they return the cash, and then the residual, the stub equity value, if they sell off the remaining assets, or if they distribute further excess cash beyond. There's additional surplus cash beyond the 14.50 per share, so they may well do something with that. I think, why is it not trading tighter to kind of maybe private market or breakup value? The question is, I suppose, what does the controlling shareholder, this Nassef Sawiris, what does he intend to do? They've said in some of their statements that they might use the cash to do something else. It could become a kind of a vehicle for a new strategy. I suppose the market is, I suppose, with that uncertainty, is not comfortable valuing it maybe on the breakup value, or what I think maybe the ultimate breakup value is. So I think that's a really interesting one as well. And I think, again, going back to the framework that I try and follow, the downside is pretty well covered. I mean, I think really the risk here is that he does a take under, and you don't get a fair value multiple at the end of it. Maybe you get a low ball take private, but he's also the biggest beneficiary of all the cash that comes off this thing. He and his family own roughly about 40%. So, I think at the same time, he's incentivized to get cash out of this. He's shown a willingness to break up a business he spent, the guts of 10 years building. He's realized a lot of cash already. And, maybe he'll take the cash and move on and do something else. So I think the value is skewed. It's skewed to the upside here in terms of the outcomes, the likely outcomes.
What are the influences on the that ammonia business, on the fertilizer business? You got gas prices on one side.
Yeah, I mean, if you track kind of the stock price, and for any of the major nitrogen fertilizer businesses, so not the other types of fertilizer, but just not like potash or phosphate, but on the nitrogen side, it pretty much tracks the price of natural gas. I think natural gas is something like 80% of the input cost into producing nitrogen fertilizer, which is typically ammonia, urea, and then there's kind of offshoot or derivative products of those two.
It's all bullshit, Toby.
Which part? That's all bullshit. That's good.
Thanks.
Had to think through it a little bit. So it's commodity. There's no demand influence on the price.
Yeah. So it's a commodity business, I suppose. In terms of the European business that's left, I suppose it doesn't have that benefit of, whereas previously it had this Abu Dhabi production that was, over 50% or more of its revenues, start of the conglomerate revenues, call it historically, where it was able to produce fertilizer really cheaply and then send it into that port terminal that they have in Rotterdam when everyone else had shut down and couldn't produce, like BASF and CF and others in Europe at the time during the energy crisis. So that I suppose angle is gone, but I think they got fair value in kind of selling that off. So so it's a question really of kind of, does the European fertilizer business rebound or recover? And you look at gas prices have come right down again. So you would think that, it's a commodity industry, it's cyclical. It's going to improve at some point. And this guy's he's a canny operator. I think he has the track record as well that I think, he's gonna get some kind of positive deal done for shareholders at some point, of which again he's the biggest shareholder, so he's well incentivized to do that.
Yeah, nicely put. JT, you want to do some veggies?
Yes, sir. So let's see. I recently learned about this Japanese concept called Ikigai. And I don't know if you guys have heard of this before. It's Ikigai. And the word breaks down into Iki, which means life, and Gai, which is interpreted as like worth or value. So put those together and you get kind of a reason to live, or kind of your calling. But before we learn more here, do you guys remember that 1978 study which found that people, they tend to have a relatively stable level of happiness, kind of regardless of major life events? And what they looked at were lottery winners and then those who became paraplegic. So it was like one seemingly very, very good life event and one seemingly very bad life event. And then how were their levels of happiness a few years after that? I don't know if you guys remember that one, but it's kind of a famous psychological study that found that it was surprising in that people seemed just as happy as before or after these major events. So that study was authored by a prominent psychologist at the University of Michigan named Philip Brickman. And he's actually the one who coined the term hedonic treadmill, which is basically like you adapt to any new environment and you feel like you're sort of running in place. And by all accounts, he was this warm, irrepressible, really engaging to talk to gentleman. Yet despite all of his academic success, Brickman struggled with his own mental health. And in 1982, at the age of 38, he climbed to the top of the Tower Plaza in Ann Arbor and jumped 26 stories to his death, leaving behind a wife and 3 daughters. So even studying happiness in depth might not be enough for your Ikigai to your reason to live, which is we'll try to cheer up the segment here a little bit. I know that was a bit, I should have given a little warning.
Bleak.
It was going to get heavy there. But so this concept I discovered from a book of the same name. And it's mostly about Japanese people and how they blend together longevity and health and purpose. And the author diagrams out these 4 overlapping circles. And one circle is what you love, and another is what you're good at, what the world needs, and then finally, what can you get paid for? And right in the center of that intersection of that Venn diagram is your Ikigai. And it's this thing that lights you up and makes you feel like you're contributing to the world in a meaningful way. And in reading this book, I was reminded of Simon Sinek's talk, Start With Why, which I don't know if you guys have ever seen that one, but I would encourage you to watch it. It's very engaging. And people really key into the bigger why of something, and then and then later you can worry about the who, what, when, where, and how. And I'll use one of Sinek's examples that he uses in the talk just to kind of illustrate the purpose. Do you guys remember TiVo? And I don't know if that's still a thing or not, but that's kind of exactly the point. They were at the time they were the first to market with this game-changing technology. A device that lets you pause live TV, skip commercials, record your favorite shows. And they were the only ones who had it, and they had it all. Like they had the cutting edge technology, reviews were great, user base who absolutely loved it. And despite all this overwhelming enthusiasm, they didn't have a massive hit that you'd expect. Like the sales were a flop. And Simic points out why he thinks they failed is that instead of focusing on the why, which is the fact that it gave you total control over your TV watching experience, they focused instead on the features. So their ads were like, hey, you can pause live TV or rewind or fast forward. But basically, they were just telling people what the product did. And Sinek argued that if you connect it to the why, which is like, are you someone who wants total control? Then boy, do we have a product for you. It lets you pause live TV, lets you rewind, lets you fast forward, but you're always in control. And like that's the big thing that separates it. So this in this book, it also then leads to the concept of flow, which, you know, if you think about, it's those things that make time just absolutely fly by. Like maybe for some people it's painting or coding or cooking or surfing or reading 10Ks, you know, who knows? But it's where you lose all sense of time and then also kind of your sense of self-consciousness in the moment. And the man behind the research into flow is this guy named Mihai Csikszentmihalyi. I'm not going to say that a whole bunch of times, and I'm not going to spell it because it's quite the mouthful. But he really cracked the code on this, and it's really about like peak performance and feeling good while you're doing it. And he was born in 1934 in a section of Italy, which is actually now modern day Croatia. And in his early years during World War II, you know, he was a kid, and like a lot of people at that time, he saw all this hardship and chaos. But what fascinated him, even as a kid, was that even how terrible things were, some people managed to stay happy in all of that craziness. And like it really stuck. That question stuck with him. Like, how do they stay positive even when the world feels like it's falling apart? And that sent him on a lifelong quest into psychology and eventually developed this idea of flow. And so, you know, when you're in that flow state, you're fully engaged, you're learning, you're growing, and you're really at your happiness. And it's like an optimal experience, right? And it kind of fits in with your, like the real time part of your Ikigai is when you're in this flow state. Everything just clicks. So, you know, I think to bring this back to the investing world, like if you study the best investors, I feel like you get a sense that they're in that sweet spot all the time. Like they're riding in that pocket, you know, you know, Buffett says he's tap dances to work every day. And you really believe him, right? And it's something they do for free. It's more about the game than the money necessarily, maybe the relationships. And if you read William Green's book, Richer, Wiser, Happier, which is really just a series of profiles and interviews of all of these stellar investors, you really get the sense that they're doing exactly what they were meant to do on this planet. And it's kind of hard to imagine them doing anything else. And I think they spend all day in that flow state, in that Ikigai. And, you know, I think for us mortals, you know, you really should ask yourself and check and make sure that you have this deep passion for investing, because you absolutely will be tested at some point. And getting your teeth kicked in for multiple years is no fun, as all of us can kind of attest to at this point. And your passion and your resolve is really going to be tested. And so you need a big reserve of it. Like it needs to feel like this is really your thing. So, and if it's not, you know, it's really difficult to compete with people who it is. So anyway, that's a little bit of more of a Japanese term that blends with some start with why, which blends with flow, which then, you know, I think you sort of see in all of the best investors.
Isn't the Ikigai like that? There's a Venn diagram that there's 3 or 4
Yeah.
little
Yeah.
circles. What are they?
The 4 circles on that were, make sure I do it in the right order. It's what you love, what you're good at, what the world needs, and what you can get paid for.
What happens if none of your circles overlap?
Yeah, if you shoot the arrow and none of them hit the circles, then yeah, I'm not sure. I think you need to spend a little bit more time thinking about what, you know, where you are and what that activity, where does it fall in those things.
That's a good one, JT. Some
Yeah,
good comments
that's
here.
an interesting one. Yeah, I think did Munger have some comment about? I think it was Munger about, you know, when you're, I can't remember the exact wording, but it was the sentiment was something like, you know, if you're playing a game with people who are better at playing the game than you're going to lose, or something to that effect. So, you know, just in terms of one of those principles, I suppose it's, you know, being good at something, you know, doing something that you're good at, or that you're naturally inclined, or have an ability for. And I think, you know, to succeed in anything really, you really kind of have to be at that intersection of, I suppose, what you're good at, what you're naturally good at, or what you have an aptitude for, with what excites you and kind of makes you want to do it, regardless of pay or outcome or status or whatever it is. I think if you're between those two in particular, those two ideas, I think that's a good place to be.
Yeah, I think Bunker has a quote about, and it's not the direct quote here I'm going to get, but something like that he was never any good at something that he wasn't deeply interested in.
Yeah.
Should we do Chord Energy?
Yeah, sure. Yeah, so that's a more recent idea that I've written about, and it's a US listed oil and gas company, mainly oil focused. About 90% plus of its revenues are in oil. So I think, again, just with, I suppose, I started looking at some oil names recently when there was really, sentiment was really starting to turn sour on oil, the price of oil, in terms of OPEC opening the taps, and um, production increasing just at a time when global demand was weakening, and whether it's US and Chinese consumption was expected to decline. So Chord Energy, I think, is an interesting one. I kind of have it on my watch list at the moment. So it's a US listed oil business. So it acquired another Canadian listed oil business called Enerplus earlier this year. So again, I suppose in terms of the situation here, it's that trailing numbers are kind of largely irrelevant, kind of a transformative acquisition in many respects. So it now has, I think, roughly about 10 years of inventory, pretty much focused in the Williston Basin, which I suppose that the Bakken formation is probably the main formation there. That was what was called the birthplace of the US shale boom back in the mid 2000s. And I think production has production has increased by over 50% following this acquisition. But the interesting thing about this business is that it kind of has a peer leading capital return framework, as they describe it. So they have a commitment to return 75% of all free cash flow to shareholders. So that's significant. So they're very disciplined on CapEx. So everything they do in terms of capital allocation is geared towards optimizing CapEx to support production and free cash flow through kind of commodity price cycles. So they're not the type that are going to get ahead of themselves in terms of drilling, over drilling. They will do or will look at selective, opportunistic M&A. And I think the interesting thing about this business is that that on a pro forma basis now, with the Enerplus assets added in, I'm getting kind of a free cash flow yield at $72 oil of about 13.5%. And now that includes some synergies, which I think management should be able to realize, and they've a pretty good track record in kind of realizing synergies on previous acquisitions. The other interesting thing in terms of this business, so it's very lowly geared. It's the lowest geared in its peer group. It's almost kind of debt free in terms of in terms of the net debt position. And the other important thing I suppose to say, as well as from a kind of an event driven angle, is that it's the leading independent producer in the Williston Basin now. So all the other producers that were there or had large production in the Williston, Hess, Marathon, they're all the subject of kind of takeovers, either completed or in the process of being completed. So it's the largest player in a consolidating region of the oil market. So when you look at how disciplined oil producers are now, in terms of, rather than spending CapEx on drilling, they're just as likely to acquire already producing assets that are well located. So you've got jurisdictional risk is low here. Obviously, it's onshore US. And what I really like about it, though, is that at it doesn't need $80 oil to really throw off a lot of cash. I mean, on my numbers, it can produce that 13% plus free cash flow yield at $72 oil and $3.50 gas. And if you can form a constructive view on energy prices and specifically oil over kind of any kind of medium term time frame, I think it's a really interesting one. You look at just bigger picture, people talk about peak oil and OPEC opening the taps, and there's all this new production coming on stream in places like Guyana and Brazil and other non-OPEC locations. But if you look at oil historically, and there's all these predictions about where it will go, but oil has traded within, if you exclude the kind of the real outlier moments like that negative oil price it hit for a short period of time in 2020, or that 2008 $145 peak when there was that kind of panic in the market. Oil has traded an average of $72 a barrel over the last 20 years. And natural gas similarly has traded at an average price of $3.50. That's the MMBTU pricing, Henry Hub pricing. So, if oil and gas prices, and we're living in an age of energy insecurity, and there's so many variables now where, I'm comfortable enough thinking that over a medium term time frame, oil is going to hover around that long term average. Sure, you're going to get peaks and troughs, but on average, I think it's not unreasonable to think it's going to stick to that type of average pricing through a cycle, if you want to call that mid-cycle pricing or whatever. And I think if you can get comfortable with that view, and you look at kind of the cash generation, the balance sheet, the jurisdictional risk is very low here. And then, it's likely, again, it's the leading independent producer in the Williston. It's been reported it and a number of its peers have been rumored to take over targets over a period of time. This business is now a much more fundamentally stronger business with the Enerplus acquisition. So it's potentially between two events in time, and in the meantime, it's throwing off a lot of cash. So I think, the bear argument here is obviously it's Williston, or the Bakken, is a mature field. No one's really too interested anymore. It's all about the Permian, and decline rates are higher now in the Williston. And, so is it going to decline faster than others? And can you believe that 10 years worth of inventory? But, I think when you look at what management are saying, what they're doing in the area, and also what a number of other players are doing in the Williston and what they're saying about it with kind of technological advancements and drilling techniques, it's not unreasonable to think that they're going to they're going to continue to generate cash sustainably from their asset base. So yeah, I think that's a really interesting name. And again, one that's overlooked. I think it has, maybe 14 analysts covering it, which might sound like a lot, but the average among its peer group is about 23 analysts covering its other peers, and it's not in the Permian, so people aren't going to care about it as much, maybe. So again, it has that kind of overlooked quality, but with, in my view, good asset coverage and downside protection. And you've got a couple of, you've got a free option on oil prices going higher. You've got, potential takeover catalyst at some point in the future as well. So, and in the meantime, they're returning 75% of free cash flow to shareholders. So, you're going to do okay on that basis as well.
That's a simple, clean idea. It's a good one. And you answered all the questions that I had as you were going there. So good job.
Yeah. What's their AI strategy though? That's what everybody wants to know.
Yeah, they've stayed silent on that. I think, yeah,
keeping
more
close to the chest.
Shipping barrels of oil, I think, is their main interest.
Conor, just more generally, why do you think that the UK has had just the stock market's had such a rough run over the last 5+ years? What's driving that?
I think, I suppose the headline reason that it doesn't have those really attractive, fast-growing, change the world type businesses that the US has with, the Mag 7 and those types of names. The UK, there's a couple of issues affecting the UK market now. It's kind of viewed, I suppose, as a stagnant one. There's a lot of, I suppose, lobbying now to get the UK government to try and stimulate uh, renewed interest or investment in equity investment in UK companies. I mean, I think as well, there's that kind of headline. US tech is just more interesting and faster growing, and you're going to get better returns looking at that, or just simplistically following that. Um, but I think then as well, you've got a real absence or retrenchment of domestic UK investors investing in UK. I mean, a lot of them have, you kind of have to follow the flows, because that's, in the short term, that's what moves stock prices, and that's what moves the likes of Nvidia and Tesla and all these other, household name companies. So I think it's really suffered from that. It's probably suffered from a lack of I suppose, forward thinking in the terms of the, government and other kind of authorities in the UK, in terms of kind of trying to um, drive investment and encourage kind of, risk taking, I suppose. Whereas you have that real culture in the US, um, which, and the returns are, when you compare kind of US and European and UK equities, you kind of, that's really played out over time. So I think, um, I think they're the main reasons, really. And I think, yeah, just generally speaking, more at a more macro level, UK and Europe is in slower growth than the US, particularly post GFC. So there is the perception that growth just isn't there. Why would I invest in the UK when I can invest in something more attractive in the US? Um, and I think as well, then one other factor is that, UK really has suffered from a shrinking stock market. I mean, a lot of companies have been delisted or acquired, um, over time, through takeovers or other transactions. So that's been a fact. Those just companies haven't been replaced. Private capital then has been a big factor in keeping companies that maybe otherwise would have listed from going public, and keeping them private.
Got a few more questions from the crowd here. One was in relation to DWL. To what extent is that weakness driven by the shift to EVs?
In the recent kind of, so they issued a kind of they guided down earlier this year, and that was related to, that was a direct kind of consequence of all the large manufacturers, Western manufacturers, really scaling back EV investment and reducing, I suppose, reducing the level of investment, and kind of the perceived kind of uncertainty then has kind of really hit the stock price. Again, although Dowlais has exposure to kind of EV growth through its relationships with Chinese, all the main Chinese EV manufacturers. So EV has been the current sentiment, around EVs has been the main issue there this year.
So they're a supplier rather than a replacement competitor for them.
Correct. Yeah.
So EV weakness is bad rather than good for them, or the other way around.
Yeah, well, yes, but also they're also pretty well established in the ICE market. So, if EVs slow down, and US, I think it's the US now has the oldest car fleet it's ever had. Nearly 15 years is the average age of a car on US roads. It's something similar, maybe not quite as old in Europe. Um, and if EVs are too expensive, I mean, the EVs are slowing down because the infrastructure isn't there to support them at the moment, and they're too expensive currently with the way inflation has gone and what it's happened, what it's done to household budgets. So if they're not an efficient mode of transport, and they're too expensive, well then people are still going to need to drive and replace cars, and so Dowlais, I think, will benefit from what I think some commentators are now talking about, a rebound in ICE vehicles. So yes, while they might be losing now in the short term in terms of on the EV side, I mean, they also have the ICE side covered, and they've also exposure to the only part of the EV market that's working, which is the Chinese piece, as I said earlier. So I don't think, I mean, this is a case of, car market's in terrible shape. Anything to do with autos is in trouble. Don't want to own it. That's kind of the headline take here. But I think when you look under the bonnet on this one, I think it's a bit more nuanced. And then you've got this whole other kind of, strategic review with the powder met business that, I think some of those kind of industry issues are not the whole story here.
What's the debt look like there? Is it how much are you kind of racing the clock?
Yeah, I think they're. I mean, I think they're about 2 times levered here, but I mean they're kind of well within covenants. It's serviceable on kind of current run rate earnings. And again, if they sell the powder metallurgy business, that just wipes all debt, and it's comfortably in net cash then.
Need another cash for clunkers. JT, tip some sand to the transmission. All those old cars make people buy new ones, boost GDP.
Yeah, there you
Glorious,
go.
glorious
Break
future.
all those windows.
Glorious future. Uh, I've got a more general one. Like these are like borderline macro, but we've all got some macro influence in our portfolios.
This is a podcaster.
uh, just generally about on the oil production ones, what do you think about sort of oil being replaced by solar or wind farms or alternatives?
Yeah, I mean, yeah, those types of alternatives, they're going to become a bigger and bigger part of the energy mix. But I mean, it's just not realistic to think that they're going to replace, they're going to replace kind of oil or gas completely. I mean, transport is only one use for oil. You look at plastics, petrochemicals. There's huge other end markets for those products that aren't going to be, I don't think that's going to change massively. I think I mean, the EV example is a good one in terms of, yes, are more of us going to be driving EVs in the future? Yeah, I think so. Are all ICE cars going to be off the road by 2035 or whatever the targets are? No, it's just not realistic. It's not actually geologically possible to extract all the minerals from the earth to actually achieve that, even if you can get permitting for mines and all that kind of stuff lined up. It's
We
just
need
not
that
going to happen.
asteroid.
How to
Yeah,
harness that
yeah.
asteroid.
But I mean, the thing is that Robert Freeland, the Ivanhoe guy, I mean, he said his statistic, or I don't know if it's his or it's just one maybe he's kind of popularized, but I mean, he said that there would be more copper would need to be mined between now and I think is it 2040 or 2050 than has ever been mined in the history of, mining, just to achieve the kind of to be able to kind of produce the amount of copper needed to kind of facilitate not just EVs, but the electrical grid, the rewiring or restructuring of the entire electrical grid. So that's just that's just so abstract that it's just not feasible to think that that's possible. So I think as with most things in life, it's all about balance, and you're going to have different types of energy, I think, for different purposes. You look at marine fuels, maybe that's going to be, they're talking about ammonia, maybe hydrogen, if that's economically feasible. It's a big question mark over that. Methanol, um, that's just, maybe in marine fuel. Then you've got in certain places, yes, wind and solar works. Um, nuclear is the obvious one. I mean, I think pretty much everyone kind of understands that now, but yes, there has been some kind of progress on um, governments and policymakers maybe getting more comfortable with that, but we're still, a long way off kind of any kind of a new nuclear fleet being able to kind of fill the gap. So I think, in the interim, natural gas is, it's the transition, it's the obvious transition fuel. See more nuclear. And I think, yeah, and I think oil as well is not really going to go, it's not going to disappear from widespread use. Again, I think going back to kind of the earlier kind of conversation around pricing, I think $70 oil over the medium term is not an unreasonable expectation. When you look at, you've got a whole, these massive trends like population growth still, urbanization, infrastructure. I think there's a book I read actually, as one of the books, actually, I think I have it here. This one, Vaclav Smil, How the World Really Works. So if you want to grow a chicken, that's 2 cups of diesel that you need to do that. So, that's that when you hear about Stop Oil and all these other kind of you know movements or lobbying to kind of phase out all of these fossil fuels instantly, the reality, I don't think they fully understand all the consequences of what they're really talking about.
That's good stuff. JT, you talked about that. You told us that a tomato is a tablespoon
man.
of diesel.
Yeah, tomatoes are
Profligate.
especially difficult because they tend to travel pretty far too. Seafood is also really energy
Yeah,
intensive.
yeah.
Unfortunately, that's time. Connor, you killed it. Conor Maguire, value situations. If folks want to get in contact with you or follow along with what you're doing, what do they need to do?
Yeah, so the newsletter is valuesits.substack.com. So you could find me there. And I'm reasonably active on Twitter or X, whichever you prefer, at Value Situations.
Good stuff. JT, final words.
Thanks, Connor. Appreciate you
Nothing to
coming on.
add.
Yeah,
Thanks,
nothing to add.
guys. Thanks, guys. Enjoyed the discussion.
Thanks, folks. We'll see you all